Hello and welcome to the webinar on magic numbers. I'm so glad that you're here today. Thank you for taking some time out of your precious life to learn something that fundamentally will change your life and your business. So what are the magic numbers? Well, fundamentally what we're going to talk about today is the cumulative effect of changing 7 levers just by 1%. And in changing these 7 levers by 1%, this can lead to over 37 times the impact over 1 year. So wherever you are today, imagine having 37 times the profit or 37 times the cash flow. That's what the magic numbers can do for you. So let's have a look at the maths. This graph on your screen here is a graph from my good friend James Clear, who's the New York bestseller of Atomic Habits. And what this graph shows is the maths of what happens if you change something 1% every day, then by the end of the year, the maths dictates that you'll be 37 times better off. So imagine being 37 times more profitable or having 37 times more cash flow. That would be amazing. You're likely here today on the webinar because you want to improve your business or improve the team or the division that you manage, and likely because you have a specific goal, a goal of improving your financial position. But whether you're here today to improve the current state, to make it easier for you, to make more money, or maybe you're here today because you've got a long-term goal to sell your business for 25 million, let's say in 5 years' time, the magic numbers can help. You can use these 7 levers either to tweak things right now, 1%, and start making huge progress in your profitability and cash flow right away. Or if you do have a very specific goal, let's say in 5 years, move to the Bahamas and sell your business, you can also use these magic numbers to work backwards to figure out which ones of the 7 levers you need to change today to hit your goal. So fundamentally, the magic numbers are about making small changes over a number of years that will make a significant difference in your business. Before we jump in, let me tell you a bit about me. Hi, I'm Glenda Lewis. I'm a Chief Financial Officer. I currently live in New Zealand, but I have lived and worked in many countries. I have over 20 years experience in executive roles and held the title CFO, CEO, and CEO. Over my tenure, I've led over 2,000 people and turned around over 25 businesses, including 2 of my own. But let's focus on a CFO. What does a CFO do, a Chief Financial Officer? Well, fundamentally, CFOs deliver the numbers that really matter. So, as a CFO, it's my job to define and deliver the numbers that really matter to my clients or to you, and to help you get the life that you want. What this means is, as a CFO, I work alongside SME businesses, do deep dives into their business, work through a clear process to ultimately design the changes that need to occur within the business so that we can focus on the numbers that matter. Sometimes the numbers that matter might be the number of hours a week the CEO wants to work. Sometimes the number is profit. I need you to achieve 10 million in profit. Or sometimes it might be something completely non-financial, like the number of birthdays that you get to attend with your children. I'm currently one of a few CFOs that partner with the CFO Centre. And the CFO Centre is an international organisation of over 600 part-time or fractional CFOs operating in over 17 countries worldwide. Today I'm going to start with some stories of what is possible when you start to play with these 7 magic numbers, and then we're going to dive into them, and I'm going to show you how these numbers work in practice with a real brewery company, so a company that makes beer and then on-sells them, and then I'm going to end the presentation today by showing you how you can make these changes in your business. Okay, so let's jump in. Businesses are much like animals. They have a life cycle. Businesses start out pretty small. They start out like a mouse. They are nimble, they grow fast, they can pivot very quickly, and this is what we would call a startup phase. Soon businesses start scaling up and they start running and leaping, a bit like gazelles. They're growing and they're changing super fast. And this is what we typically refer to in the business world as scaling up. If businesses are run well, they can stay in the scaling up or this gazelle state forever. However, if businesses are not careful, they end up becoming elephants, becoming really slow moving, slow to change, and way too big and cumbersome to run fast. So one of the ways to stay as a gazelle company is to constantly make 1% changes and to focus on these magic numbers. Every quarter, you might want to bring them out, dust them off again, tweak the next one to make sure that your business is working for you and that you're making these 1% tweaks as you go along to make sure you've always got the most efficient running business. So let me tell you now about two businesses that I've worked on recently. They vary in size and complexity, but they all had one thing in common. They had numbers and potential for cash flow and profit, but they just needed to be unlocked. And what I mean by that was there was pockets of cash and profit and valuation hiding in certain areas that just needed somebody with financial expertise, likes of myself, a CFO, to dive in and find them. And after all, that's a CFO's job. That's my job. Within the first 3 months of jumping into these companies, I'll show you very shortly, you can start making some really impactful financial changes to these businesses just by tweaking a few of the magic numbers. So let me show you a few stories. So this business was doing very well, and what you can see here is this is their revenue graph on here. You can see that their revenue was growing. It was growing about 25% a year. So that's great. Except what wasn't growing was their bank account. And this is down here. You can see that they had an overdraft of about $150,000. And no matter how much they grew, they couldn't seem to budge their bank account. So this client came to us and said, look, I've got a great business model, a great product. My business is booming, but my bank account isn't. Can you please help? So after 4 months of playing with a few magic numbers, what ended up happening was the revenue kept growing. Remember, this wasn't a revenue problem. He still had a great business. So basically, we didn't touch anything on the revenue side. But look what happened on the cash flow side. His bank account went from being 150 in overdraft to then he had about 300,000 in his bank account. And this result was just from tweaking some of those 1% magic numbers. Let me show you another example. This was a business where the owner wanted to sell. He'd had enough and just wanted out. So he was ready to sell, but the problem was his business was in decline. This graph that you can see on his screen is what I call EBITDA, or a pretty good reflection of net profit. So his business had been tanking for about the last 2 years. I asked him before we put it on the market if I could jump in and run the business alongside him for 12 months where I'd help him get the company back up and running into a shape that would generate a lot higher sale value that he ultimately needed to retire. So in this instance, he knew what he wanted to sell the business for. I could tell from where the business was today, he was never going to get there unless we started tweaking some things. So obviously you can see the starting position was not a pretty picture. What ended up happening was 9 months later, this is what happened after we started tweaking some magic numbers. The profit doubled, the cash in his bank 4 times, and he ended up having somebody buy out his business for 3 times the value in just 12 months after he got a valuation at this dip here. And now he's literally happily retired, spending every day on the beach. Okay, so before we get started on the magic numbers, I want to just ask you a few questions to set the stage. When you look at a business through a financial lens, what are the 3 things that a business owner wants the most? Well, the most common answers that I receive as a CFO is firstly to improve their cash. Most business owners want more cash because it reduces stress, reduces pressure, and allows them to sleep at night. The second thing I often hear is I want more profit. This is going to attract investors, allows me to pay dividends, and that just sounds really great from a small to medium-sized business owner's point of view. And the third thing that people normally say is I want to grow my business valuation. Ultimately, one day I want to sell my business, move to the Bahamas, and I want to get a good price for my business. And so these are the 3 things that people typically think about. As we go through the magic numbers, we will be concentrating on 2 of these things, the cash flow impact and the profit impact. As fundamentally, you need cash to survive, and then I'll show you how tweaking these numbers will drive more cash. I'm also going to show you the impact on profit, and these are very different. At the end of the presentation, I'm then going to jump through and I'm going to show you how you can then use these magic numbers, not only to tweak cash and profit, you can also use them to tweak your valuation. Okay, so we want to grow our business, maybe sell it, maybe move to the Bahamas. But if you want to grow your business, what is the first thing that you typically think about doing? Well, in our experience, most owners say, I need to increase sales. I need to grow my business. I need to have more sales. And the reason that people come up with that is normally it's the obvious choice. Like it makes sense. If I want a bigger business to have more profit, I've got to increase. But what's the problem with that strategy? After all, increasing sales, surely it does help a business grow, right? Well, the problem with increasing sales is that it really ignores the reality of the business. It's hard to grow sales without growing more costs or growing working capital. So even though growing sales is part of the puzzle, there are 7 levers to play with, and growing sales is only one of them, and typically the other 6 get ignored. So what are the 7 levers or the 7 dials that we have to pull in a business that will grow cash, grow profit, and grow business valuation? Well, there are 4. There are 4 that relate to what I call the profit and loss or the income statement, and then there's 3 on the balance sheet. Now is a great time to explain these 3 financial reports that you actually need to be looking at as a business owner, and then I'll jump back from these 3 financial reports into the 7 levers to tie these all together. Fundamentally, as a business owner, there are 3 pieces of paper or reports that you need to learn how to read, or I'm going to call them business gold mines. First of all, there's an income statement. This is often known as a profit and loss or P&L, and it shows where your money is coming from and where it's going to. The second thing as a business owner or a business division leader that you need to be very clear on reading is what's called a balance sheet. And right now, this is probably the thing that your accountant gives you once a year. You don't understand it, so you might just sign it and move forward. Well, you really need to understand what's on this one. It's fundamentally the balance sheet shows you the amount of assets and the amount of liabilities your company had. So if I can use a very simplistic example here, it would be if tomorrow something happened to your business and you had to turn all of your assets into cash, you had to sell them and get cash, and then you had to pay up all your liabilities from your pile of cash, how big would the remaining pile of cash actually be? That's important, right? So the balance sheet fundamentally tells you the difference between the size of your asset pile and the size of your liability pile. So you need to know that to run your business. So please make sure, if you don't know how to read your balance sheet, now is the time to jump in and learn a little bit about it. Thirdly, the statement that you need to get really close and up personal with is your cash flow statement. This is not the same as your income statement, and it is not the same as your balance sheet. It is different. Profit or your P&L doesn't necessarily lead to cash, and cash doesn't necessarily mean you made a profit. So this little statement here, your statement of cash flow, is really important to know. Remember, as a business, we have levers that we can pull in our profit and loss, right? Sales being one of them that we just talked about. We also have levers that we can pull in our balance sheet. And we might think about them as individually things that we need to do to grow. But all of these working together, if we can identify the 4 levers in the income statement, the 3 in the balance sheet that we can tweak, that will be how you generate the most profit. So now let's jump back and actually talk about the levers that we're going to play with today. So as I said, there's 4 on the profit and loss and 3 on the balance sheet. The first one on the profit and loss is the pricing. And all of these things are things that you can control as the business owner or the GM or the MD, the person that's running the shop. So pricing, you can increase your prices. If you are selling one widget for $5, you could increase that to $5.50 tomorrow. That is one of your levers. The second thing that you can do is you can increase your sales volume. Although we stated earlier that you can, that is one of the levers, remember it's only one of the 7 levers. And just because you can increase your sales volume doesn't mean it's always the smartest play. The third thing that you can do is you can reduce your COGS or cost of goods sold or direct costs. So your direct costs are everything that you have to put into your good or service to ultimately be able to sell it. So for these, you have at your disposal things that you could do to decrease your cost of sales. You technically could reduce wages by making your staff more efficient using things, or you could negotiate certain pricing agreements or discounts, volume discounts. You might be able to, bundle together and go in and ask for rebates at a certain amount. There are lots of things that you can do to reduce your direct costs. The fourth thing that you might be able to do is you can reduce the cost of your overhead or your indirect costs, or some people call these fixed costs. Fixed costs, typically that what we see are your overhead wages, so the people in your back office making your business work. That often in New Zealand is your biggest cost on your fixed as part of your fixed costs. We also see really high motor vehicle costs or insurance costs, things like this. That is one of your levers that you get to play with to reduce those certain costs. Right, so these are the four that you get to adjust on your income statement. If we now jump to the balance sheet, there are three that you can adjust on the balance sheet. The first thing on your balance sheet that you can play with is reducing your debtor days or the accounts payable. What this means is try and get your customers to pay you 1 day faster. Remember, we're talking about 1% tweaks. So how would you get your customers to pay you 1 day faster? The sixth lever, or the second one that you have on your balance sheet, is reducing your stock days or your work in progress. And this is if you are actually manufacturing goods or widgets, like a specific good at the end of your process. What we're looking at here is how can we reduce the number of days that those widgets are sitting in your warehouse, both before and after you've sold them, and get them out faster. If you are a service business, we're talking about how can we reduce the amount of work in progress that you've got sitting on your balance sheet at any point in time and get that invoiced faster so the cash comes in. Then the seventh lever we're going to talk about is increasing your creditor days or your accounts payable. And this literally is just talking about taking 1 extra day to make those supplier payments that you are obligated to make. So you might be paying them on the 19th of the month right now. A 1% tweak would be pay them on the 20%, on the 20th. All right, so to bring these levers to life, I want to introduce you to Tina. Tina loves beer, as I'm sure some of you do. So much so that 4 years ago, she started her own microbrewery company, and this has done amazingly well. 2 years later, she's now distributing all over New Zealand and into Australia. She's opened a tasting room and now employs over 20 staff. Tina's business is called Hop Makers Limited, and she's very well known. Her team is really successful, and she is constantly busy. But Tina wants to be a gazelle company. She wants to stay as a gazelle company. She wants to grow more, but she also wants to figure out how to run it smarter. She's come to us because she said her revenue is growing and she's doing really well, but it seems like her bank account is not reflecting all of the great work that she's putting in, and she wonders if we can jump in and take a bit of a look into what is happening. So before we get started and jump into Hop Makers, I just want to make sure we're all clear on how Tina's business works behind the scene. Tina fundamentally makes revenue through volume and price. Volume being how many cans of beer she sells, and price being what price does she sell them for. So volume times price equals the revenue that she makes. Once she's made this revenue, then she has to pay off all of her direct costs to get to her gross profit. The direct costs that you have to incur in a microbrewery, in case you don't know, is you've got to buy some grains that she's going to use. She probably has to buy some yeast, any of the fermentation chemicals. She also needs to buy the costs of the cans. All of those things are her direct costs. So once she's taken over the direct costs, she ends up with what we call a gross profit. The gross profit is the amount of money that then Tina can figure out what she wants to do with that and where to spend it. But remember, now she still has some fixed expenses. Fixed expenses are the things that you still must incur to do business, but they are not directly related to the cost of each can that you are producing. So to give you an example here, Tina's fixed cost is rent. She rents a premises, so she's got to pay rent. She has back office wages. She has a bookkeeper that does all of the bookkeeping. She has a few admin people and some receptionists to help the tasting room. She also has to pay electricity, insurance, etc. And those are all of the fixed costs that come off to end up with a number that we're going to call net profit. Net profit percentage here is how many cents in every dollar that makes it through this funnel as a profit. So if you think about if she was to sell $100 worth of beer, the net profit percentage would be out of $100, how many dollars end up as net profit that then sits in her bank account. If you don't know what that number is for your business, here's your first challenge for today. Figure it out. You should know what your gross profit percentage is and what your net profit percentage is for your business or the division that you run. You should also know what is reasonable and what you're doing to bridge the gap. So if you don't know any of these statistics that I talk about today for your business, my challenge is for you to find out. Okay, so now let's jump in and look at Tina's company, Hopmakers. Okay, so what you can see on your screen now is this is our special software, the Magic Numbers software, where you can actually see into Tina's business, Hopmakers Limited, and the financials. And so we're going to use this and we can dive through and we can play with things. At the end of today, I will be giving an offering that if you want this software to be run and a finalized report for your company, we have a special offer today. So what you're seeing on your screen now is exactly what we can do for your business. So what we can see with Tina here is that she has a revenue of $12 million. So that's, remember, her two levers, what she's selling her beer for and how many units she sold. So that leads to $12 million for her last year. Her direct cost of goods sold is $7.4 million, which leads to a gross profit of $4.5 million. This is now calculating what her GM is. So her GM percentage is 38%, which, you know, if you don't know what your GM percentage is, first challenge, make sure you know what it is, and also know what is reasonable in your industry. Then what we can see is she's paying $3 million, just over $3 million for her overhead, so her fixed costs, which then leads to her operating profit of $1.4 million. And that is as a percentage is 8.5%. As a general rule, I want to stop here and say, first of all, if you don't know any of these numbers for yourself, you need to figure it out. You need to sit down with your bookkeeper or your accountant and figure out what your numbers are. Second of all, once you start actually getting to your operating profit number, there is a level that is acceptable and there's a level that's not acceptable. It's what I call the red zone. So as a net profit number, you've got to remember that the net profit is representing every $100 of revenue, how much is going to end back in your bank account after you've paid all the expenses. But this is before you pay income tax or GST or any of your loans or anything like that. So typically what I look for as a CFO is we want to be hitting at least 10%, i.e. for every $100 of revenue that we sell, we make at least $10 profit. And why I look for that number is because then at 10%, you'll just have enough to pay your taxes and start moving forward, but you're not going to move forward hugely in leaps and bounds. So what I would call as in an okay zone is somewhere between 10 and 12%. Anywhere less than 10%, I'm going to call the red zone. It is a danger zone for your business to live in. It is possible to live in that zone if you have really high volume, no debt, got all your taxes under control. But why I call it a red zone is it's going to be really hard for you to make a lot of progress if you're sitting at less than 10% profit. So have a look at what your numbers is. Are you in the red zone? Are you less than 10% profit? Are you in the okay zone, 10 to 12, 13%? Or anything typically above 12 or 13% is sitting in a really nice tidy zone, which will mean at 15% net profit, let's say, you've got enough money to pay your taxes, pay some of your loans, and maybe even at year end, then a little bit of money left to invest in the future. So takeaway here, if you don't know what your numbers are, figure it out and figure out how close you are to the red zone or the green zone as I've just told you. So this cool little calculator here, it also tells us her situation on her assets and her liabilities and how much equity she's got. We can see here that on average, her customers take 61 days to pay us. Again, you might think that is a long time, but what's yours? And how are you working to reduce yours? You can also see that her inventory days is 127 days. What this means is once she's actually produced her beer, it sits in her holding cell or her factory for 127 days before somebody buys it. That's quite a long time, but again, if you're selling goods, what's yours? Figure out what yours is and where you need to get it. Accounts payable, so you can see she's been a little bit naughty. She is taking on average 73 days to pay some of her suppliers. So this likely means some of her suppliers are not super happy. But remember, the whole reason Tina has asked us to look at her financials is because her revenue's going up, but she doesn't feel like her bank actually is. Then we can start having a look at certain amounts of debt, where she's getting her funding from, etc. But I'm going to switch through and I'm going to show you how to run this tool. So we're going to run into her profitability. So what you can see here is these graphs here are showing her gross margin, and it's showing them over the last 3 years. And so we can run the situation for you so you can see your last 3 years how things are happening for you. So you can see in 2002, she had a gross margin, in 2002, she had a gross margin of 40%, then it dropped to 39, then it dropped to 38. This is very common in businesses that we look at, is the gross margin slips, or slippage is what we call it. And a lot of businesses say, oh, it's not that big, it's not going to have that much of an impact. It actually does. You can very quickly work out how much profit it's taking away, and it can be tens, if not hundreds of thousands of dollars. So what you can also see here is you can see that her net profit has also slipped. She used to be making 10%, which remember was right on that zone of being okay, but not great. And now for the last 2 years, she slipped into the red zone, and now she's at 8% profit. So remember, this means for every $100 of revenue that she is generating, she's making $8.50 in profit. And remember, we want to be at least 10. What you can see here now is we can start to see some other really cool information. So how much is her revenue growing versus how much her direct cost is growing? Typically when revenue grows, what we want to see is the direct cost growing slightly less, which logically should make sense because as you're buying more off your suppliers, you should be able to dictate slightly lower pricing, slightly better volume discounts, rebate discounts. If your suppliers don't give you that, then you then have economies of scale to move to somebody that's cheaper. But what you can actually see here is what's happening is last year her revenue grew 25%. Remember, she said she's having a good go at things. The microbrewery business is going really well. So she's growing at 25% in revenue, but her costs last year grew 27%. i.e. her costs are growing faster than her revenue, right? Which is what's leading to her gross margin shrinkage. We can also see the same this year. Her revenue's grown another 20%. That's amazing. Year over year, growing 20 or 25%. That is a great story, except her costs are growing faster than her revenue. We can also jump in and we can see that what's happening with her overheads. So you can actually see her overheads are starting to dip a little, which is very nice. So there must have been some changes that she made on her overhead side to reduce some of her costs. So maybe she got more efficiency out of her renting her warehouse. She might have got more efficiency out of her staff. She's doing something right on the fixed expenses, which is really great. And then we kind of get a table of all of the biggest, most important metrics that we should be looking at. So let's continue our journey here to learn a little bit more about Tina's business. Okay, so these graphs now are showing what's happening on the balance sheet. The first 2 pages I showed you were all about profit and loss. They were all about revenue and pricing and direct costs and fixed costs and profit. Now we're pivoting to have a look at those 4 levers that sit on the balance sheet. So again, they don't drive profit, but they do drive cash flow, and they will drive your business valuation. So please make sure that you understand these 3 levers as well. So what we've got here is we've got her accounts payable days. This is on average how quickly she's paying her suppliers. You can see she is getting faster at paying her suppliers, which I'm sure that they're quite happy about. Her inventory days are slowly going up. So this is how many days she keeps her cans of beer on her shelf before she sells them. This is now up to 128 days. That's quite a long time. Again, if you're looking at this going, wow, that's really long, I would challenge you to say, what is yours? And thirdly, let's have a look at her accounts payable days. This is on average how many days her customers take to pay us. 2 years ago, they were taking 50 days, then they inched to 51, and now they're up to 61 days. Taking a look at all of these things allows us to come to something called the working capital timeline or the cash conversion cycle. And I'm just going to jump here back to my other screen and show you what this means in very simplistic terms so that we know what we need to do to look at Tina's company. Okay, so now let's jump in and talk about what is a cash conversion cycle. Well, fundamentally, a cash conversion cycle is the number of days it takes from when a business first outlays its cash until when it gets the cash back. So this is a number of days, and the lower the number that we get here, the lower the CCC, the lower the working capital days, the better. In fact, it can be so low, it can even go negative. So when we think about our cash conversion cycle, I want you to think about it representing how fast can a business convert its initial money out to coming back in with return. Okay, so let's have a look at what would happen in a real business. Typically, the first thing that would happen is you would hire a salesperson and they would go out and get some quotes and you would be paying their wages before you've got any sales in. So typically, your first cash out is wages. Then what's going to happen is Tina's going to go, wow, my salesperson is so good, I actually need to start making some of this beer. So she's going to start purchasing the inventory, the cans, the fermentation chemicals, all of the grains, everything that she needs in her direct cost to start producing the beer. So she's going to order it, and then what's going to happen is she's going to pay those suppliers. So at this point, we're paying wages for our salesperson and we're paying our suppliers, but we haven't got any money in the door. Then the next thing that happens is our salesperson goes, yes, we've got our first order and we have a secret party about that. And so then we actually sell our inventory to the customers. We give them the invoice, but remember, they have a certain amount of terms on the invoice, but so we don't actually get the cash back in until maybe 1, 2, maybe 3 months afterwards. So the cash conversion cycle is the number of days it takes from when you first outlay your first piece of cash. So whether that's for you paying the salesperson, whether it's investing in product, whatever, the first thing is that you put cash on. How many days does it take between when you put that first piece of cash out to when it actually comes back? So as you think about the cash conversion cycle for your business and how many days it is, let me throw something out there that might blow your mind. So there are some businesses that have a negative cash conversion cycle, and obviously this would be amazing because a negative cash conversion cycle means cash comes into your bank account before any cash goes out. And let me give you an example of this. Amazon, the massive online retailer, has a negative cash conversion cycle. And what you can see here is at their peak, they had a negative cash conversion cycle of 40 days. What that means was they had the cash in their bank account for 40 days before they actually had to pay anything out. That is super impressive. So what this means and how this happens is, remember, Amazon is an online retailer of other people's goods. So what they do is the customer, if you're interested in buying something on Amazon, you put in your credit card gets charged, and Amazon gets the cash in their bank well before Amazon has to go to its supplier and say, hey, Glenda just bought a new XYZ, now can you please ship that to Glenda? And at that point, Only at that point, when the supplier ships it to me, does Amazon actually pay for its services. So or to its suppliers. So on average, Amazon's cash conversion cycle is negative 30. So this is obviously an average over certain months, but on average, Amazon's cash conversion cycle was negative 30 days. So the thing that I want you to take away here is, what is your cash conversion cycle? Where are you at currently? What would be your perfect cash conversion cycle? And how can you get there? Okay, so now let's jump back into Tina's business and have a look at her cash conversion cycle, or sometimes this is known as the working capital time frame. And the cool thing about our little calculator here is it shows you what it was last year, what it is this year, and how much cash you've lost or gained from any slippage over the year. So what you can see here is last year on day 0, her inventory arrived. So this would be her barrels and her cans and her fermentation stuff, everything that she needed to start. On day 84, she paid her creditors. Then on day 108, so again, we're adding our averages here, she actually sold her first can of beer. And then on day 159, her cash was actually banked into her bank account. So the difference between day 0 being the start of the cycle and day 159, the difference from when her cash came out to her cash came back in was 75 working days. So that's her cash conversion cycle, 75 working days. And if you think that's really terrible, you absolutely need to calculate your own. I've had so many businesses look at this and say, wow, that's really bad. Mine is a lot faster than that, only to figure out that theirs was even worse. So now let's have a look this year. So in 2024, her numbers are slightly different. She orders her inventory on day 0. She's now got slightly faster at paying her creditors, which is obviously, I'm sure they're happy about that. So she pays them on day 74. But she's now holding her inventory for slightly longer. Presumably because she was growing at 25%, she's got to hold a little bit more in her warehouse for big sales. So on day 128, she's now selling her inventory. And then it takes a while for her customers to pay her. So on a day 189, her cash is banked. So this year, her working capital days, or her cash conversion cycle, is now up to 115 days. That difference here, that growth, has cost her $932,000. Obviously, that is pretty extreme, but again, if you don't know what your cash conversion cycle is, what it was last year and what it should be, and how much money it's costing you, I don't want you to blame Tina here. I want you to jump on yours and try and fix it. There's a few other really cool things that we can jump into here. For example, where you invest your money and how much investment you get back. We can also start having a look at, of your gross margin number, how much do you put back into your balance sheet versus how much do you put anywhere else? To give you an idea here, remember Tina's gross margin percentage was 38%. So what that means, out of every $100 of revenue, $38 ended up as gross margin. But her working capital on her balance sheet, that's how much stock and her customers need for it to keep going at this speed, takes away $26 of that $38. So what you can see here, out of every $100 of revenue, she gets $38 left in gross margin. But of that 38, 10%, remember, remained as profit, and $26 is going to her balance sheet, which, if you do the maths then, means she's only got $2 left to spend on anything else, which is why her bank account is going down. So typically when we look at how much money is coming from your gross margin versus your working capital, you want the money going to your balance sheet being less than half, ideally even a third, of what was coming from gross profit. Okay, again, this tool gives you some really cool other working capital ratios. Okay, just for a second here, I'm just going to introduce another concept to you, which is your return on investment. And some of you might be sitting here going, I know what my return on investment is. Great. If you do, that's absolutely awesome. I'm going to introduce you to a slightly different way of thinking about it. When you think about your return on capital or return on investment, basically what you're talking about is what is the return that I'm getting from my business, right? When you think about this, you want to compare it to other things that you could invest in, right? A Westpac term deposit or some shares, etc. But remember, when you are returning money in your business is a high risk investment. So you're wanting here to get a substantial return, not just the 6% you might get on a term deposit. So there's a way of figuring out what your ideal return on investment actually should be. And it's back to these two concepts, your profit and loss and your balance sheet. So let me just show you how it works, and then we'll jump in and look at Tina's. So remember when we talked about your profit and loss should be generating at least 10% return. That's of your $100 of revenue, you should be ending up with $10 in your bank account of profit at the end. So what I'm going to call that is I'm going to call that 10% P&L return, or your profit on your return. Now remember, your business is made up of your profit and loss and your balance sheet. So effectively, your return on investment is just the return that you make on your profit and loss multiplied by how efficiently your balance sheet is working for you. We know as CFOs from studying many businesses that a good balance sheet should be returning at least 3 times. What this means is every $3 that you put as investment into the business, you should get 3 times that once it's gone the full circle back as profit. So I know that my ideal balance sheet turnover is 3 times. So now it just becomes a maths exercise, because I know my return on investment is what my profit and loss makes and what my balance sheet is contributing. So literally just 10% times 3. I know that my minimum expected return on investment is 10%. Okay, now let's jump in and have a look at what Tina's is. Okay, so now let's jump in and have a look at Tina's return on capital. And what you can see here is hers is 19.6%. I know this looks a little bit complicated, but remember, it's the same principle we talked about before. It starts with your P&L efficiency. How much profit do you make for every $100 in revenue, right? That's the calculation here, your profit efficiency. The middle part, again, looks a bit complicated, but it's basically how efficiently is your balance sheet running. Multiplying these two together, you get your return on capital or return on investment. Remember, we are ideally targeting at least 30% because we want our profit efficiency to be at least 10%, our balance sheet efficiency to be at least 3 times, which means our return on capital as an absolute minimum should be 30%. Tina's is not, it is 20%. That shouldn't surprise us because remember, her profit was, even though her revenue was going up 25% year over year, her profit has started declining and now she's making less than 10%. She's only at 8.5%. We also know on her balance sheet side, she's taking a long time to pay suppliers. She's keeping a lot of stock on hand for a long time before she sells it, and her customers are taking a long time to pay her. So all this is adding up to having a return on capital that's less than 30%. All right, now let's have a look. And what I'm going to do here is I just want to jump to now show you the power of 1. So the power of 1, this is where we get really excited about our 1% changes, and we can start seeing how much things, we can start playing with things in real time. So what you can see here is Tina's business currently makes 1.5 million in profit. That was her 8.5% profit that she made from her 12 million in revenue. However, remember from her cash conversion cycle, she is losing money. So even though she's making 1.5 million in profit, she is losing $1 million in cash every single year. What we've got here is down here, we've got all of our 7 levers that we learned about the start. Increasing price, increasing volume, reducing her direct cost or cost of goods sold, reducing her overheads or fixed costs, reducing accounts receivable, reducing her inventory days, and increasing her accounts payable. And what we can do here is we can play with them, and at the bottom here, it shows you what her final position is. So what I'm going to go through here is I'm just going to go through and play with some of the things that I think is probably necessary to try and turn Tina's business around. Okay, so we're going to start with the top one. Prices. Let's say I've gone to market and I can see that Tina's prices are slightly low, but not too low. She just hasn't really made any price increases for this financial year. So I'm going to encourage her to put up her prices by 3%. So not a big increase, Just 3%. Right, so what you can see already is a 3% impact on prices has increased her profit by 360 grand and also increased her cash flow by 300 grand. So now her cash flow is only down $750,000, but we still got a long way to go. Let's say that I don't want to play with her volume. Remember when we started, often businesses think, if I need to make more money, I need to sell more. Well, I want to show you today that that is not true. So I am going to assume that she's not selling any more than she currently is. Cost of goods sold reduction. Okay, so let's say we dive into Tina's operations and we see that she's never asked for a bulk payment discount. She's never asked for 10-year discounts. She's never switched suppliers. In her 4 years, she's still using the same kind of pricing model. She's never gone around. She's never tendered for anything. So on average, when we see that, we can normally get prices down between 3 and 7%, either by switching suppliers or asking them for rebates or saying, hey, look, once we hit $2 million, I want 3% off, etc. There's lots of different ways that you can negotiate with your suppliers. So let's say we start doing that, and I'm going to say on average we get Tina a 5% discount. So what you can see here already, this impact on her operating profit is $372,000, and it's hugely increasing her cash flow as well. So now her profit's up to $2 million and her cash flow is only $300 negative, and all we've done is tweak 2 levers. Remember, her overheads already looked pretty good. She'd gone through a bit of a culling exercise already, but I know from talking to her that Tina hasn't looked at motor vehicles, she hasn't looked at fuel, and she hasn't looked at insurance. She's only kind of looked at some of the big ones. We know as CFOs that when you go in, there's certain line items on your P&L that we can look at right away and say that is too high. And there's certain lines that I've done that with Tina. I can see she's paying a little bit too much insurance. There's certain areas she's paying insurance on that she doesn't actually need. Her deductible is really, really low, so she's paying in excess for that. I can also see that she doesn't have preferential buying at certain gas stations, so she's paying a lot for her fuel and her diesel that she could probably get 3% off. So I'm going to say, on average, I think we could get 3% off her fuel bill and probably more like 7 to 8% off insurance. So we'll make this 4%. So again, this is saving her $123,000 on her cash flow and on her profit. Right. Now let's jump to her balance sheet. Remember, these 4 were all linked to her profit and loss. These final 3 are all about the balance sheet. So what you'll see when we start playing with them is there's going to be no profit impact, right? The profit impact we've got is baked in. This is all going to have a cash flow impact. Now remember, when we had a look at how many days it took her customers to pay her, it was over 70 days. On average, if your debtors are over 50 days, you probably have a big problem. You're going to need to look into proactive collections. You might need some software to automate things for you. You're going to need to make way more phone calls. Maybe you need to text your customers. Maybe you need to look at your invoicing process. Maybe you've got issues with POs. As a general rule, if you are asking people for 30-day payment terms and they are taking a lot more than 30 days to pay you, you have a problem with your process. Go right back to day 1 and have a look at how many days does it even take you to get the invoice out. In some businesses, it can take 5 days after month end to get their invoices out. Well, customers aren't going to pay you 5 days earlier for that. So have a look, again, right through your cash conversion process. How many days does it take you to do everything in your process? Tina here is sitting at over 70 days, and I would say with absolute certainty we should be able to get this down to 40 days. So we may even be able to do it greater, but I'm going to say that we should be able to cut 30 days off her accounts receivable just by implementing new systems, proactive changes, contacting our customers for POs earlier. Maybe we even need to bring in a dedicated collection person that is paid as an incentive to collect, but we absolutely should be trying to get this down substantially lower. Remember when we talked about inventory days, she was also holding her stock for about 127 days before somebody bought it. There is kind of an ideal amount that you hold your stock for, but it is dependent on the industry that you're in and how long it takes you to make your goods. On average, in normal working conditions, so putting COVID aside, you probably want to hold about 2 months worth of stock as turnover in case you get bulk buying and if you're waiting for things overseas. If you run just-in-time inventory, which means you are just ordering it in right when a customer orders, obviously the amount of time that you have to hold your inventory is much, much, much lower than that. If you are not sure what your ideal is, have a look at your stock turnover, i.e. how quickly you turn over your stock, and figure out how much stock you would need to have on hand for 2 months, and start there as a minimum, and then you can always play with it to get slightly faster. If you have certain stock lines that turn over a lot faster than other stock lines, what I would recommend you do is you calculate your stock turnover for your fast turnover items and for your slow turnover items, and you have a different ordering frequency. What I do know in the microbrewery business is we want to hold somewhere between 45 and 60 days worth of stock, because every now and then we got some really big orders from our customers, and so I want to always have enough stock on hand. I don't want to be the person that always runs out, so I want to hold it for 60 days, but we also know that she's holding it for 127, so I'm going to say on average we should be able to cut the amount of days that we hold our stock by 60 days. It could even be more than that. Now, accounts payable, she is currently taking a lot longer to pay her accounts payable than probably what we should. So we probably need to actually speed up how fast we pay them. So I'm going to go negative on this one and say that we're going to actually be nicer to our suppliers, and we might pay them, let's say, 6 days faster. Right. So what you can see now is we've gone from a position with Tina having 1.5 million in profit but going backwards $1 million to all of these changes now making 2.3 million and going forwards. Her bank account is going up $1.9 million. So remember, the only P&L change we actually made was we increased our prices 3%. Like, that is not much, 3%. And we reduced some of our direct costs with volume rebates, things like that. Again, not a lot, only 5%. And we cut some of the expenses off our balance sheet by renegotiating insurance and motor vehicles. And that alone has driven our profit up $855,000. With the combined changes of being smarter on inventory and bringing in new processes on accounts receivable, our cash has now gone up $3 million. Phenomenal, right? This is the power of 1%. And so once we put your company's numbers in here, we can play with them in real time and show you what the impact is. One of the other really cool things that we can do here is we can very quickly work out what we think a high-level valuation of your business is. Again, it's not tailored. It uses a pretty high-level formula, but what it shows you is what your business value is today versus what it would be if you made the 1% changes. So we can tell Tina, actually, your business is worth 1.3 million today, and she might go, oh, that's really disappointing because I sell $12 million worth of product, and we'd say, yeah, we agree with you. However, once you make those 1% changes, just on the prior screen, it will add $5.5 million to your valuation. So if all she did over the course of the year was just focused on those 5 things that we tweaked, her business valuation would jump to 6.8 million. So she would then quadruple, more than quadruple the value of her business valuation just by making those very high level tweaks. Okay, so that was Tina's brewery company. Now I want to give you some real life CFO examples and when we've gone into companies and implemented the magic numbers or just tweaked some of these 7 items. So this business here was a business we got asked to jump into, and it had been very evident that pricing hadn't changed or been normalized for a long time. So I jumped in and did a bit of a segment analysis to see which branches, which geographies could actually sustain some price increases. Some of the areas were put up 7-8% and some of them were only put up 0.5%. So this is what happened just as a result of pricing increases. Profit in 6 months was up 49%, their cash doubled and their valuation was up 27%. Again, that's only changing one lever. Here's another example. This is accounts receivable. So this is how quickly your customers pay you. So again, this was a real example here of a company that we were trying to unlock some cash for. What you can see here is the height of the bar is how much money they had outstanding with customers at any point in time. So for this particular customer, they had 600 grand sitting out with customers. And what you can see over the course of us working with them, it wasn't that there was less debt outstanding with customers, but what happened was we changed the makeup. So what you can see here is this blue line was the debt or the customers that owed us money, and it was more than 90 days old. This orange was debt that was more than 2 months old. The grey was more than 1 month old, and the yellow here was current debt. And what you can see here is this line here is our DSO, or on average how many days customers took to pay us. We got it down from 53 days at the start to 39 days at the end. And what happened was this unlocked $315,000 in cash. So again, this was one of the 7 levers. We didn't play with the P&L. This was just a cash flow impact. Now, if we have a look at what happens if you change multiple magic numbers at the same time, this business called us in because the overdraft kept getting bigger and bigger and bigger, and the business manager just didn't really know what was going on because he thought the results looked okay. He didn't end up having good management statements, so we implemented that, and we came in and we started tweaking a lot of the 7 levers. Although, full disclosure, I did not change volume because I didn't want to grow this business right before we sold it. The business manager was under a lot of stress. I just wanted to play with the other 6 levers, and this is what happened. The profit doubled, the cash doubled, and the valuation tripled. So now it's over to you. Now I'm asking for your accountability. What is the 1% change that you are committing to making today on your business because of your learnings about the magic numbers? As a special thank you for listening to this webinar today, I want to give you a special offer. You can book your own personalized magic numbers consultation, taking you and your business through exactly what I did with Tina's business, including a really great personalized report that you'll get at the end with all the findings, which includes 1 hour with a CFO to take you through what we see and the key changes that we would recommend for you to make in your business to really drive it forward. Also, if you're interested, we could reverse engineer your business based on a valuation that you want. And this Magic Numbers report and CFO session is normally priced at $750, but today, as a special thank you through this webinar, we are offering this to you at $369. So about half price as an offer to say thank you for today. So if today really piqued your interest in any way, or if you're interested in the Magic Numbers offer for $369 to have this done for you and your business personally, please email me at glendalewis@cfocentre.com. That's my email address on the screen, and I look forward to helping you drive your 1% changes in your business to 37 times your cash flow and profit. Thank you for your time today.